Good day. So we will discuss the deductions of gross income. So I'm your discussant, Rebecca Armakiwing. First, let us differentiate exclusion versus deductions. So when we say exclusion, it refers to amount not included as reportable gross income in the income tax return. So please refer to the previous video about the exclusions of the gross income. While deductions, they are included in the amount of gross income, but presented separately as deductions from gross income in the income tax return. So what are the deductions from gross income? So first is we have allowable deductions. So there shall be allowable deduction from gross income other than the compensation income. So these are the expenses incurred in the conduct of trade or business to arrive at the net income. So the taxpayer has the options now whether to deduct the expenses, either itemized deduction or optional standard deduction or OSD. So our base for OSD is 40%. So it depends upon you whether you will use the itemized and the OSD. For computation of the OSD, we have for individual, this is 40% of the gross sales or the revenue, while for the corporation is 40% of the gross income. Okay, so our tax base here for individual, you exclude the passive income which is subject to final withholding tax. The same also in the corporation. While their difference is on the cost of sales of services. So for individual, they are not allowed to deduct the cost of sales or services. But for the corporation, they are allowed to deduct. So meaning the 40% of the rate would be based on the gross profit. So sales less cost of sales is equal to gross profit. And then if they choose the optional standard deduction, 40% coming from the gross profit. While for individual, you are not allowed to deduct the cost of sales. So what are the income subject to regular allowable itemized deduction? So the following items of income are granted with itemized deduction. So business, professional income which derive within and outside the Philippines by a resident citizen. We have also business or professional income derived within the Philippines by a non-resident citizen, a resident alien, and a non-resident alien. Next, we have also business, professional income of a general co-partnership, business income derived within and outside the Philippines by a domestic corporation, business income of proprietary educational institution and non-profit hospitals, business income of proprietary government-owned or controlled corporation, and business income within the Philippines earned by a foreign corporation. So they are allowed to deduct allowable itemized deduction. So what are the composition of regular allowable itemized deductions? So we have 11. So number 1 is general business expenses. Number 2, interest. 3, taxes. 4, losses. 5, bad debts. 6, depreciation. 7, depletion of oil and gas wells and mines. 8, charitable and other contributions. 9, research and development. 10, pension and trust. 11, premium payments on health and or hospitalization insurance on individual. Later, we will discuss the rules regarding the deduction of these regular allowable itemized deductions. Okay, so first let us discuss the general business expenses, which is part of the allowable itemized deduction. So take note, you can only use this one itemized deduction if you are not prompting the 40% OSD. So you will use this type of deduction. So for general business expenses, we have the salaries, wages, management expenses, commission, and labor. So part of your operating expenses, the supplies, repairs, and maintenance, and other incidental expenses. The operating expenses of transportation equipment used in the trade, profession, or business. The rental for the use of business property, advertising, and other selling expenses. Traveling expenses while away from home solely in the pursuit of trade, profession, or business, and insurance premiums against fire, storm, theft, accident, or other similar losses in the trade or business. So you are allowed to deduct it. But we have some requisites. So what are the requisites? So it must be ordinary and necessary for the conduct of business or exercise of profession. Of course, they are substantiated with official receipts or any other adequate records, and reasonable in amount. They are withheld with tax and paid to the BIR if required, such as the salary expense. And then they are not contrary to law, morals, public policy, or public order. And of course, they are incurred or paid and deducted within the taxable year. So these are the special rules, no, on deducting some expenses in your financial statements. That is part of the deduction, that is allowable deduction for your gross income. Okay, so first is the representation expense. So what is representation expense? These are entertainment, amusement, recreation, no? Expenses incurred or paid during the year that are directly connected to the development, management, and operation of the trade, business, or profession of the taxpayer. So they are subject to the rules and regulation by the Secretary of Finance. So we have two rules. For the sale of goods and properties, your representation expense would be 1/2% of the net sales for taxpayers. So net sales meaning you less the sales returns and allowances and the sales discounts. So 1/2% of that would be your ceiling, whichever is lower to your representation expense actual versus the ceiling. So that would be your deduction. Next is for the sale of services, including exercise of profession and use or lease of properties, 1% of the net revenue for taxpayers. Okay, so what is the requisite? It must not be contrary to law, morals, public policy, or public order. Of course, there is evidence, there is official receipts and adequate records. It must be limited to the ceiling requirement, and there must be some definite reasonable purpose connected with one business. No? So, mere giving of parties to entertain the employees and personnel does not indicate a definite business purpose. So, there is a definite purpose. Okay, because some abuse this representation expense. So, example. If a business is a trading business, the deductible amount of representation and entertainment expenses would be this one. No? If their net revenue is 6 million, the ceiling rate is 1/2%. So they are trading in business. So the ceiling is 1/2%. So times it. So our deductible amount is 30,000. But if the business is service business, okay, your ceiling rate is 1%. So 1% of 6 million, that is 60,000 versus the actual expense, which is 50,000. So you will use the lower, no? So your representation expense would be 50,000. That is part of your deduction in your gross income. Okay, interest expense. This is the cost of money incurred within a taxable year on indebtedness in connection with the taxpayer's profession, trade, or business. So you can deduct this. This is allowable deduction, but there is a requisite now. There must be a valid indebtedness. The indebtedness must be of the taxpayer. The indebtedness must be connected with the taxpayer's trade, business, or exercise of profession. Interest expense must have been paid or incurred during the taxable year. Interest must have been stipulated in writing. So there is some writing, there are document. Interest must be legally due. Interest payments must not be between related parties. Interest must not be incurred to finance petroleum operations. In case of interest incurred in acquisition of property used in trade, business, or profession, the same was not treated as capital expenditure, and the interest is not expressly disallowed by law to be deducted from gross income of the taxpayer. So that would be part of your allowable deduction. Okay, interest expense is subject to limit. No, there is arbitrage limit. So if the taxpayer has interest income, which is subject to 20% final tax, let's say for example, there is an interest income in the bank, this is subject for final tax. So then they are the same time incurred, no? And there is an interest expense and interest income during the year. So the interest expense shall be reduced by 33%. Effective January 1, 2009, as amended by RA 9337. So the tax differential rate on interest to reduce the actual interest expense is now 33%, whether the taxpayer is an individual or corporation, as amended by the RA 9337. So again, if there is interest income within that year, no, which is subject to 20%, so the interest expense will be reduced, so it will be deducted 33% of it, no, so that lesser, no, the expense, the interest expense of that year would be lessened to compared to the actual. So what are those interest expenses that are deductible in full? So the business has no interest income, which is subject to 20% final tax, so deductible in full yan. The interest expense is paid in favor of the government, and the interest on delinquent taxes is deductible because taxes are considered legal debt when due. As a rule, interest paid to the government shall not be reduced by tax differential because the beneficiary of such interest is the government itself. So again, this is not, there is no deduction, there is no limitations if the interest expense is paid in favor of the government, so that is deductible in full. Okay. So what are those non-deductible interest expense? So the non-deductible interest expense are the following: interest payment on indebtedness not business related, interest payment in favor of a relative, related debtor and creditor, interest paid in advance, interest to purchase or carry tax, which is exempt transactions, interest paid on indebtedness to finance petroleum exploration, and interest on unclaimed salary is not deductible from gross income. Okay, so at least clear. So you need to familiarize those non-deductible interest expense. So we have some illustration. Illustration for interest expense. So GM, a taxpayer, the following interest expense and interest income in 2019. So interest expense on bank loan, 200,000. And then he has also interest income from time deposit and from promissory note. So only the interest income from time deposit is subject for final withholding tax of 20%, no? So again, there is arbitrage limit if there is final withholding tax. So our interest expense, deductible interest expense would be like this, no? Of course, we have the 200,000 less the arbitrage limit, 50,000 times 33%. So our deductible interest expense is 183,500. Okay. Next, assuming GM paid 300,000 interest expense from a business loan, and then receive net interest income from deposit of 80,000. Okay, so meron siyang 80% na interest from deposit. So your deductible interest expense shall be computed as follows. So we have the gross interest expense, which is 300. Our arbitrage limit, why will you divide it with 80%? So 80,000 divided by 0.8. So since this is already net interest income from deposit, meaning the final tax was already deducted. Unlike in our previous example, that is not netted, meaning the final tax, this is still subject for final tax 20%. However, in our second example, netted already, meaning deducted na yung final withholding tax. So let us first get the gross interest income of that interest income on the deposit. So 80,000 divided by 0.8. Okay, just to get, so meaning to say our interest income, the gross interest income from the deposit is 100,000 less the withholding, so our net interest income is 80,000, right? Net interest income. So But the 30% arbitrage limit would be based on the gross, katong subject pa for final withholding tax. So, doon sa gross, not the net. Okay, so I hope you know that concept, no? So, 80,000 divided by 0.8. So, your gross is 100, right? So, 100 times 0.33. So, 33,000 ang ating arbitrage limit. So, our deductible interest expense, 300 less the arbitrage limit is 267,000. This is deducted to your gross income. Okay, next, taxes. Taxes are allowed as deduction, okay, when paid or incurred within the taxable year in connection with the taxpayer profession, trade, or business. So, in case of the non-resident alien individual engaged in trade business in the Philippines or NRETB, and as resident foreign corporation, deduction shall be allowed only if and to the extent that they are connected with income from sources within the Philippines. So at the option of the taxpayer, the income tax paid to any foreign country is treated as an item of deduction or tax credit. Okay? For the resident alien, resident alien and the resident citizen. So they have the option as item or of deduction or tax credit. Okay, later we will have an example on it. So what is the requisite? It must be paid or incurred within the taxable year. It must be paid or incurred in connection with the taxpayer's profession, trade, or business, and the tax must be imposed directly upon the taxpayer. Okay. So we have taxes deductible from gross income and taxes not deductible from gross income. So taxes deductible from gross income, percentage tax, documentary stamp tax, occupational taxes, privileges and license taxes, the excise taxes, the French benefit tax, import duties, the local business tax, except special assessment, the automobile registration fee, community tax, municipal tax, and income tax paid to foreign country if not claimed as tax credit. So, deductible yan from gross income. So, ano ba yung mga not deductible? We have the Philippine income tax except French benefit tax, the final income tax, the capital gain tax, the regular income tax, the state and donors tax, the foreign income tax if claimed as tax credit, percentage tax on stock transaction, value-added tax, taxes not related to business, trade, or profession, and other items related to tax such as special assessments, surcharges, and compromise penalty. They are not deductible, so you need to familiarize this, okay? Okay, so our illustration for taxes is this, especially for domestic corporation because meron siyang taxes no from foreign countries. So, meron din siyang option yung taxes niya from foreign countries, either deductible approach or i-tax credit niya, okay? So, here, meron siyang taxable income from the Philippines which is 2.8. Meron din siyang taxable income from Japan which is 2,200,000. Na-deduct na yung mga deductions nito, ha? So, domestic corporation, they are subject for for income tax within and without, diba? So, taxable income from the Philippines 2.8, when we are using deductible approach, so our total world income, taxable income is 5 million, okay? And then, kasi deductible approach man, gilesen ang income tax paid in Japan, which is 800. So, ang taxable income world, which is 4.2 na, no? Multiply by the corporate income tax 30%. So, corporate income tax due is 1,260,000. Meron naman siyang quarterly estimated income tax which is paid in the Philippines 500. So, income tax payable for that year is 760,000. Okay, so let us compare when it is tax credit approach. So, total natin, our total income is 5 million. Multiply with the corporate income tax 30%. So, our corporate income tax is 1,500,000. So, less the Philippine tax credit income tax credit 500,000 yung nabayaran niya. So, i-less din natin si foreign tax credit. So, how to get the foreign tax credit? Foreign taxable income divided by the world taxable income times the Philippine income tax due. So, whichever is lower, ha? So, actual foreign income tax paid natin is sa 800,000, di ba? And then, multiply natin, 2,200,000 divided by world, 5 million, times ang ating Philippine income tax due, 1.5. So, equals 660. And then, whichever is lower. So, our foreign tax credit is 660, no? So, our income tax payable for that year is 760. Sa ating example, nagkapareha. Pero there are cases na depende na sa imuha, no? Ang goal lang talaga dito is yung malaki ang ma-minus as income tax payable. Sorry, mas mababa na income tax, no? So, you use the two approach, and kung naka-lesser ka doon, so you use that one, either deductible, kung nakababa yung tax natin, or either tax credit. Okay? Okay, next. We have also charitable and other contributions. So for charitable and other contributions, they are non-operating expenses. But the law allows, no, some contributions or gifts given within the taxable year as deduction from the gross income. And we have some requisites. First, the taxpayer making the charitable contribution must be engaged in profession, trade, or business. There must be actual payment of contribution or gift. The recipient must be an entity or institution specified by law, and the net income of the institution must not inure to the benefit of any individual or private stockholders. So when you give contribution or gifts to charitable institution, those who are, let's say, what are example of charitable institution? Bantay Bata, what else? Home for the aged, those are charitable institutions. So those are the requisite, but there are rules, no, on how to, how much would be the deduction. Okay, proceed to the rules. So we have contributions deductible in full. So these are the any amount that you contribute to charitable and other contributions, any donation, no, to the government of the Philippines or to any agencies or political subdivision, including fully owned government corporation exclusively to finance, to provide or be used in undertaking specific priority activities in education, the health, youth and sport development, human settlement, science and culture, and economic development. They are deductible in full. What else? Donations to international organizations in compliance with agreements, treaties, or commitments entered into by the government of the Philippines and the foreign institution or international organization or in pursuance of special laws. They are deductible in full. And then, donations to accredited the NGO, non-government organization, subject to the following requisite. Okay? Not more than 30% of which should be used for administration purposes. The contribution must be utilized not later than the 15th day of the third month after the close of its taxable year. So, ano ba yung third month natin? March, no? Not later than March 15. And then upon dissolution, a court shall distribute the asset of the said NGO to another non-profit domestic corporation or to the state or to another similar organization. So if the requisites are being followed, so they are deductible in full. So other than the full deduction of the charitable contribution, yung mga hindi nasali, no? Hindi nasali sa mga full deduction, they are subject to limit. Okay? So, ano ba yung limit natin? For corporation, 5% of the taxable income, which is derived from business before contribution. And then compare it to the actual, whichever is lower. For individual, 10% of the taxable income derived from trade or business, still before the contribution. And the actual versus natin, whichever is lower. And then, kailangan pala sigurista si BIR. This donation must be properly documented with receipts, of course. Okay, this is our example for charitable and other contributions. We have Mr. Joey. Meron siyang gross compensation income, 500,000. And then, meron din siyang gross income from business, 1 million. And fully deductible contributions, 200,000. And then, meron din siyang contributions deductible with limit, which is the actual is 50,000. Then, non-deductible contribution, so exclude natin talaga yan, no? Other deductible business expenses. So, our limit for the contribution deduction would be, of course, we need to compute first, now the net income before contributions. 1 million less 400,000. Okay? Multiply by the individual limit percentage, which is 10%. And then, our deductible limit is 60,000. But you need to compare it with the actual deductible, actual contribution, which is 50, whichever is lower. So, meaning, you use the 50,000 as your deductible. And then, add the fully deductible contribution. So, your total deductible contribution expense is 250,000. Okay, next, contribution to pensions and trust. So, how to compute our deductions? So, the actual contribution to the extent of the pension liability, add the amortization of the past service cost. That is your total amount deductible. So, when we say pension liability, this is the normal cost. When we say past service cost, this is the excess of actual contributions over the normal cost. It shall be amortized over 10 years. We have an example here. Okay, so pension expense is usually accounted for based on the estimation made by the actuary using assumption, di ba? So, for tax purposes, employer pension contributions are deductible only to the extent of the normal employee retirement or current employee costs for the year. So, normal employee retirement or current employee cost of the year. And any excess of contribution over current and normal should be amortized over a period of 10 consecutive years for tax deductibility. So, in our example, Jowen Manufacturing, if you observe in 2018, there is past service cost, while in 2019, walang past service cost. Meron din tayong current service cost and contribution to the fund. So, when we are asked how much is the deductible pension expense in 2018, our answer there is 550,000. So, just observe pension contribution less funding of current service costs, which is 500,000, and then compare it to 2019. Diba? So, why is it 500 ito, while this one is 410? Sa 2018, ang ating normal cost is 500. Why hindi 400? Diba? Kasi meron manggutang past service cost dati, no? So, our normal cost here is 500. Kasi sabi on the rules, they are only deductible to the extent of the normal employee retirement or current employee cost. Sa 2018, meron kasing past service cost. Kaya yung normal natin is 500. Kung wala sigurong past service cost yung 2018, so mag-base tayo sa ating current employee cost, which is 400. And then, di ba? So, in 2019, walang past service cost. So, ang ating current employee cost is deductible. Okay? 410. And then, excess funding, amortize it for 10 years. Again, for 2018, kasi meron tayo past service cost, so we use the normal cost, which is 500, not the 400, the current cost. While in 2019, we use the current service cost. And then, add the amortization. Okay? Kasi amortize yan for 10 years. Plus also, yung amortization last year. So, our deductible pension expense for 2019 is 479,000, while our deductible pension expense for 2018 is 550,000. Okay, now let's go to the research and development costs. So, what are the treatment? We have two treatments now for the research and development costs. RD related to capital accounts used in business are capitalized as part of the cost of the property and deducted through depreciation expense. So, anong treatment natin noon? And then we have also the RD, which is not related to capital accounts, which can be claimed as follows at the option of the taxpayer. So, katong number 1, kasi related to capital accounts man na, so hindi ko siya deducted, no? Kaya part naman siya sa property, so ang madidak lang anak katong depreciation expense niya. Pero kanang RD, not related to capital accounts, meron siyang option ang ating taxpayer. So, outright expense and deferral. Deferred and amortized over a period not less than 60 months. So, 5 years, beginning from the month the taxpayer realized benefits from the research and development expenditure. So, let's look on our example. Okay. So, during 2019, Juan Manufacturing Company incurred 3 million in the conduct of research relative to a new product to be introduced to the market. So, the company finally started full-scale commercial production in year 2021. So, how many years? 19, 20, 23 years. Compute the deductible research and development expenditure for 2019 and 2021 under outright expense and capitalized and later amortized. The deductible research and development expenditures under the two options. So, we have first the outright and the deferred. Okay? So, for 2019, if it's outright, the whole 3 million. If deferred, only in 2021, then 600 lang. So, if you are the depende na sa imuha, no? Pero for me, I would like outright expense. Kaagad, ma-minus kaagad sa ating gross income. Pero meron man din mag-defer, no? So, i-amortize it for 5 years. Okay. Now, minor or ordinary repairs and maintenance. So, what are the treatment? If the repairs add the value of the property, capitalized. If the repair is to prolong the life of the property, capitalized. But if the repair is to make the property efficient now in its operating condition, outright expense, deduction to your gross income. Okay? How about kung i-capitalize, no? So, if it is capitalized, you will amortize it for over 60 months. So, that is 5 years. No? It can be amortized over 60 months. Okay? So, I think kana lang, no? Thank you so much. And please don't forget to subscribe to our YouTube channel. See you in our next video.